Okay, let's unpack this. Welcome to our deep dive into, well, the absolute essence of what's moving capital right now.
It's a big one this week.
It really is. We are tackling the latest reserve of KMBU Financial News and Reports Magazine Weekly Market Digest and Investment Analysis.
hmm
Specifically, we're looking at that crucial edition that covers the week wrapping up on November 29, 2025. And I have to say, this report is a goldmine. It really captures a decisive inflection point in the markets.
That inflection point is absolutely the key takeaway.
Yeah.
I mean, if you just glance at the executive summary, the story isn't just that the week ended strong. It's that it completely erased the memory of a very, very challenging November. And that month was significant. You have to remember, it was the first overall losing month that the major indices had seen since all the way back in May.
So a long stretch of gains broken.
Exactly. But
Yeah.
that negative sentiment, all that selling pressure, it hit a wall.
Yeah.
And then it reversed hard.
So we're not talking about some gentle, slow recovery here. This sounds more like an aggressive shift. Just how aggressive are we talking? When you look at the S&P 500, the Dow, the NASDAQ, what's the benchmark for this performance?
Oh, it was a monumental turnaround. All three of those major indices, they posted their most successful week in almost 6 months.
6 months.
We're talking since June of 2025. And when you see that kind of, cross-the-board strength, money isn't just trickling back in, it's rushing back in with some serious momentum behind it.
And you could see this technical.
Immediately. The conviction was visible right away. The KMB Wave Digest points out we saw consecutive days of upward gaps.
Wait, okay, let's pause on upward gaps for a second. That's one of those technical terms that I think holds a lot of weight, but not everyone might grasp its importance. What exactly does an upward gap signify to you?
It's an incredibly robust sign of momentum. It shows that buyer conviction is so high that the buying is happening overnight or, between trading sessions.
So it's not even waiting for the opening bell.
Not at all. An upward gap just means the market's opening price for the day was significantly higher than the closing price from the day before. Essentially, there's so much buying interest after hours or in the pre-market that the price literally jumped over the entire previous closing range.
And to see that multiple days in a row.
Seeing consecutive days of this, as the report notes, it just signals that the market is absolutely convinced the short-term direction is definitively up. And the drivers were very clear. It was primarily the semiconductor sector and some pretty significant strength in energy as well.
That robust momentum, it takes us right into the engines of growth, right? The sectors that were physically pushing these indices higher.
Absolutely.
And if you just look at the raw index performance numbers in the digest, the NASDAQ Composite was the clear leader. It posted a change of plus 0.78% for the week. That's outperforming both the Dow and the S&P 500.
Which is the clearest signal you could ask for.
Right. It's telling you that technology, and specifically that chip story, is where the fresh capital is flowing.
It's a classic tech sector rebound, really, but has a very specific catalyst, and that's AI.
Of course.
Earlier in November, we saw what a lot of analysts were calling a healthy skepticism. It was this brief cooling-off period where valuations, especially in those big AI-focused names, were being questioned after that massive run they had.
People are getting a little nervous.
A little bit. But the market's response at the end of the month, it suggests that dip wasn't seen as some big systemic warning sign. Instead, it was viewed as a perfect buying opportunity. The confidence in this multi-year, AI-driven growth story, it hasn't wavered one bit. If anything, the enthusiasm is back, and it's even stronger.
And we don't even have to wait for the closing bell to see that enthusiasm, right? We can look at the pre-market data that the KING-KAMBUF report details. That often acts as a proxy for institutional intent.
Right.
So who was buying aggressively before the market even opened?
The pre-market session was highly instructive. I mean, to see massive price movements before the opening bell, you need serious, highly liquid institutional interest. You need big money moving.
It's not retail traders doing that.
No. Yeah. And the top performer by a mile, signaling a really unique high-conviction thematic play, was Cameco Corporation, ticker CCJJ. It saw an absolutely astonishing pre-market gain of plus 16.97%.
16. Wow, that's not a small rotation.
It's not. That is a definitive, immediate response to the macro energy thesis. It was likely fueled by some big news or maybe a series of strong analyst upgrades, all related to this accelerating demand for uranium.
That's nearly a $15 gain per share before the average investor could even realistically react. It just underscores how urgent the money flow into resources and that whole energy transition theme is right now.
Exactly. And while Kamiko was the percentage leader, the big tech giants were also showing immense eagerness. Microsoft, MSFT, which is really a bellwether for enterprise AI deployment. It jumped a very healthy plus 3.59% in pre-market trading. That added over $19 to its share price. When you see a behemoth like Microsoft moving that much before the open, it tells you institutional money is completely convinced about the forward path of corporate tech spending.
And if we look at the shares actually changing hands throughout the week, the trading volume, that commitment to the core chip sector becomes, well, undeniable. This wasn't a rally based on some obscure microcaps.
Oh, not at all. You look at the volume charts in the digest, they're just dominated by the foundational players in the AI structure. NVIDIA led the pack. It was consistently averaging somewhere between 121 million and 194 million shares traded daily.
Every single day.
And Intel, INTC, was right behind it, hovering between 96 and 108 million shares. I mean, when the average daily volume of the two largest U.S. chip makers is consistently breaking that 100 million share mark, it signifies a deep structural commitment. Investors are using that liquidity to establish or, rapidly expand their core positions. It's confirmation that the market is placing its biggest bets on silicon.
This level of enthusiasm, this conviction that the price will be higher tomorrow, it brings us to a really fascinating concept the report touches on in the sentiment section. It's called the Tinkerbell phenomenon.
Right.
Especially in relation to Bitcoin, which was trading near $86,000. It sounds whimsical, but it has some pretty serious implications for high-growth tech, doesn't it?
It really does.
Yeah.
The Tinkerbell phenomenon, and it's named after the character from Peter Pan, of course. It refers to the idea that an asset maintains its value or even generates new value simply because enough people believe that it does.
It's belief creating value. Like if you don't clap, she disappears.
Precisely. If you stop believing in crypto, its price theoretically collapses because it doesn't have those underlying traditional assets like fixed cash flows or physical resources to back it up.
So it's pure sentiment.
Pure sentiment. And what's so critical here is how that sentiment bleeds over into equities. When you see Bitcoin trading at $86,000, it reinforces the narrative for high beta, high risk, high reward tech stocks. The market's willingness to sustain such a high valuation in crypto signals a general risk-on appetite.
It's a barometer for risk tolerance.
Absolutely. And that's why we see crypto-exposed companies like CleanSpark, CLSK, and Bitfarms, BITF also showing up in the volume leaders list. The collective confidence that fuels the crypto market is the same confident risk tolerance as pouring money into the most speculative, but also potentially most rewarding AI and chip plays. It's all just interconnected confidence in future narratives.
So the engines are roaring on what? Pure belief and technological necessity. Now we need to kind of assess the context, the surrounding environment, which takes us right into the volatility and policy landscape. The volatility picture, based on the VIX, it underwent a pretty dramatic psychological shift.
Yeah, and if we connect this to the bigger picture, the volatility analysis is arguably the most powerful technical argument for continued upside as we head into the end of the year.
Okay.
The VIX, the SIBO Volatility Index, which people often call the fear gauge, it spiked up sharply on November 20th. It reached a level of nearly 29.
Which is high. That's a lot of fear.
That's intense investor anxiety. And a reading like that often coincides with short-term market bottoms. At that point, everyone who was going to panic sell has probably already done so.
So the sellers are exhausted. And what happened after that peak?
We saw an immediate sharp contraction in that fear. By the end of the week, the VIX had plummeted right back down into a much healthier 18 to 20 range. And this massive drop generated what the KING-KAMBUF digest identifies as a VIX spike peak signal. That was on November 21st.
And that's a specific, recognizable technical pattern.
Very specific. It occurs when volatility rises sharply and then reverses just as rapidly.
So what makes this signal so actionable? Why is there a specific, predictive time frame attached to it?
Well, that's the fascinating detail here. Technicians who track these patterns have found a pretty strong historical correlation. When this specific spike peak signal is generated, it often precedes a period of positive market performance. You could call it a relief rally that tends to last for about 22 trading days.
22 days.
Roughly. Now, it's not a guarantee, obviously, but it provides a strong historical probability that the short-term selling pressure is just exhausted. And since this signal was activated on the 21st, it suggests there's a technical tailwind that could extend positively all the way through late December.
So it's a mechanism that effectively signals the market has discounted November's uncertainty, and the path of least resistance is now higher.
That's a great way to put it. It's not just a feeling of calm. It's a historically validated indicator suggesting the market has structurally removed a major psychological headwind for the next 4 weeks or so.
That's some solid context for anyone thinking about year-end positioning.
It provides a strong anchor for investors to lean against, for sure, especially for those who were maybe a little timid during that November correction. However, and this is a big however, we cannot ignore the larger macro factors,
The Fed.
specifically the Federal Reserve. A technical signal doesn't just override fundamental monetary policy.
Right. The digest highlights that the Fed is still the elephant in the room. What are market participants really monitoring when it comes to potential interest rate changes in December?
The focus has completely shifted. It's not about hikes anymore. It's about the Fed's communication around future rate cuts.
The pivot.
Exactly. The market has pretty much priced in a strong likelihood of the Fed holding rates steady in December. That won't be a surprise. But investors are highly sensitive to any language that suggests an accelerated timeline for rate reductions in 2026.
And a more accommodative signal, even just a hint.
It would pour gasoline on the tech rally. I mean, lower rates significantly improve the present value of future earnings for growth stocks like all of these semiconductors we're talking about.
And on the flip side,
Conversely, any hawkish surprise or even just overly cautious language from the Fed could quickly invalidate that 22-day VIX signal. It's a very delicate balancing act right now. The market is essentially betting on the Fed not rocking the boat during this crucial holiday rally period.
and speaking of delicate balances, we have this immense friction between economic fear and actual consumer behavior. The report notes this persistent consumer anxiety, yet the early Black Friday and holiday shopping data offered. What did it say? Some support. This feels like the core conflict.
This is maybe the most difficult paradox to interpret right now. I mean, on one hand, you look at the surveys and they show Americans are deeply anxious about inflation, job security, the whole economic outlook.
Right. That anxiety suggests consumers should be tightening their belts, delaying big purchases.
And on the other hand, that initial burst of holiday spending suggests they're still opening their wallets, even if they're doing it reluctantly.
So what does some support actually mean when we translate that into market language? What's the takeaway for you?
It means the retail apocalypse that many were fearing hasn't materialized yet, but the spending is highly selective. People might be buying that one necessary item, or they're hunting for discounts, rather than engaging in broad discretionary splurging.
And this tension is where the market will find its ultimate direction.
It has to. If that anxiety finally translates into a sharp drop in spending come January, then the tech optimism could be seriously challenged. If, however, the spending continues through Christmas, the market gains a fundamental backing that complements that technical VIX signal we talked about.
So we need to watch where people are spending. Is it luxury or is it deep discounts?
Exactly. And that distinction brings us perfectly to the critical divergence we need to talk about next. Because here's where it gets really interesting. We have to contrast this absolute technological euphoria with the measurable economic pain points that are visible in consumer stocks. It is a perfect example of a bifurcated market.
A tale of two markets.
Truly, it's two markets operating at the same time. You have companies that embody structural growth hitting new 52-week highs, showing you where the long-term capital is congregating.
So let's get into the concrete examples of that market leadership from the digest.
Okay, let's start with Broadcom. AV It's a key player in high-end networking and infrastructure chips, and it's trading right near its 52-week highs, around $370 a share.
The year-to-date gain is what just floors me. The report cites a massive 138% to 140% gain. Year-to-date. I mean, you simply cannot ignore a stock that has almost tripled in a year. What does that kind of performance imply about the expected longevity of this AI cycle?
It implies that investors view this as much more than a cycle. They see it as a structural rewiring of the global economy. That 140% gain isn't just froth or excitement. It's confirmation that AVGO is successfully delivering on its AI chip and infrastructure integration strategy.
And it's not alone.
Not at all. Micron Technology, MU, also hit its 52-week high range. That validates the recovery of the memory chip cycle, which is absolutely essential for AI adoption. This performance isn't accidental. It's being driven by huge institutional mandates to acquire exposure to high-growth infrastructure.
And what about those high-risk, high-reward alternative assets, the ones that really live on pure exuberance and future projections? They must be accelerating too.
Oh yeah, you have to look at the extremes. Galaxy Digital, GLXY, which is a major crypto investment and financial services company, is up 239% year to date.
Wow.
And Open Door Technologies, Open, which is heavily involved in the iBuying real estate space, has just exploded with a 309% YTD gain. These massive percentage moves reflect the market's high-risk appetite, which is inherently linked to the same confidence that's driving the chip sector. These are bets on exponential futures, where the growth is assumed to justify what look like astronomical valuations today.
And we already noted Cameco, CCJ, hitting 52-week highs, which validates that whole energy transition thesis. The world needs nuclear power. Uranium is the fuel. Now let's flip the coin. Let's look at the weariness. Where are the consumer headwinds showing up most painfully in the market?
The other side of this KING-KAMBUF report is genuinely alarming because it directly contradicts all that optimism. We're seeing severe pain in consumer retail, in durable goods, and in housing, the sectors that are most sensitive to household discretionary income and, of course, interest rates. The losses are concentrated, and they are sharp.
So give us the specifics. What are some of these recent 52-week record lows?
You have to start with Tapestry, ticker TPR. This is a luxury accessories giant. They own brands like Coach and Kate Spade.
Big names.
Huge names. And it suffered a brutal single-session loss of minus 16.30% from its highs. This is a critical signal, because a loss that sharp, that fast in the luxury segment, it suggests that even the more affluent consumer, the one who is often thought to be protected from inflation, is pulling back aggressively on discretionary high-ticket items. It's a massive flight risk signal.
A 16% drop in one day isn't just a bad quarter. That's a systemic concern about forward guidance and the consumer's willingness to spend on things they don't need.
Exactly. And the pain extends out to durable goods and housing-related sectors. Deere & Company, DE, which is tied to large capital expenditures in agriculture and machinery, dropped 6.51%. Amcor, AMCR, a global packaging leader, was down 6.44%. Signaling concerns about future manufacturing and distribution volumes.
So it's broad-based weakness.
It is. Even Ulta Beauty, ULTA, fell almost 5%. The digest specifically points out that this weakness is heavily concentrated in housing. It names Lennar, LN, and DR Horton, DHI, as notable decliners, and the broader durable goods sector. This tells us the consumer is spending, yes, but they are absolutely deferring large capital-intensive purchases, or they're trading down aggressively.
This divergence, it really is the central thesis for investors, isn't it? You've got this structural bull market in AI fighting against a cyclical slowdown in consumer spending and manufacturing.
Whose story wins heading into the new year?
Exactly, and that makes the upcoming earnings season just absolutely critical. Which, of course, brings us to our next segment, Earnings Insight. The week of December 1st through the 5th is heavy, with reports that will serve as the first concrete tests of this market dichotomy.
That's right. And we have two key reports that directly mirror these opposing trends.
Let's start with the tech and AI check-in. That's Salesforce, CRM, reporting on Wednesday, December 3rd. Why is this report so much more than just another software earnings announcement?
Salesforce is a crucial proxy for enterprise health. It tells you about the willingness of corporations around the world to commit serious capital to digital transformation and AI integration.
And the market is expecting robust numbers.
It's very robust. The projected EPS is $2.86 on revenue of $10.27 billion. That represents significant year-over-year growth. But honestly, analysts are looking past the numbers. They are fixated on the management commentary.
Okay, so what are the specific high-stakes talking points that investors will be listening for from CRM's leadership?
The first one is the momentum of the AI revolution within their actual client base. We need concrete color on how quickly they are monetizing their new AI-powered products and features. Is this all just hype, or are companies actually paying real money for AI integration services?
That's the key question.
And second, the market is intensely focused on tech M&A activity. CRM itself has a history of high-profile acquisitions. If their management signals strong corporate confidence, potentially implying future aggressive M&A or high capital expenditure on AI infrastructure, that will validate the bullish sentiment for the entire tech sector, including all of their semiconductor suppliers. A strong, confident report from CRM is like a tidal wave for tech sentiment.
So if CRM shows corporations are still spending aggressively on their future, it provides cover for those massive valuations we're seeing in the chip space.
It does. And we also get Snowflake, SNOW that same day. Another key cloud data player expected to report EPS of about 0.31 cents, which will further help us gauge the health of cloud spending.
Okay, now let's cross that market divide and look at the consumer gauge.
And that role falls to Dollar General, DG, on Thursday, December 4th. This report is essential because DG is the absolute gold standard for measuring the health and behavior of the value-conscious consumer.
Right.
Their expected EPS is $0.93 on revenue of $10.6 billion. But again, we need to focus on the guidance and the commentary around same-store sales and foot traffic.
And why does Dollar General's stock performance specifically highlight this bifurcated consumer landscape you're talking about?
Because the stock itself has rallied nearly 50% this year. It has dramatically outperformed the S&P 500 by about 30 percentage points. And this rally isn't because the economy is booming.
That's the opposite.
It's the exact opposite. It's because if the consumer is under pressure, if they're feeling that anxiety the report cited, they're trading down. Instead of buying groceries at high-end supermarkets or discretionary goods at mid-tier retail, they're moving into discount channels.
So if DG reports strong results,
If DG reports robust results and positive guidance, it confirms that the consumer is actively managing their spending, prioritizing value, and supporting the discount segment while abandoning those high-end discretionary names like Tapestry. It confirms economic stratification.
and that stratification is the key. People are still spending, but they are desperately seeking efficiency. I see Kroger, KR, also has earnings that day, expected at $1.03 EPS. That'll provide another look to the grocery consumer's wallet, but Dollar General feels like the true indicator of household stress.
I agree. And we have a few other key reports rounding out the week that kind of flesh out the picture. On Tuesday, we get the Bank of Nova Scotia BNS, which gives us insight into Canadian banking stability and broader North American lending. American Eagle, AEO, also reports, giving a look at fast fashion and youth retail sentiment.
Okay.
And then later in the week, DocuSign, DOCU, and Hewlett-Packard Enterprise, HPE, report on Friday. They offer further, more specialized insight into enterprise software workflow and hardware spending. But undeniably, CRM and DG are the two reports that will set the emotional tone for December.
All right, so let's translate all of this analysis, the volatility signals, the tech momentum, the consumer caution into concrete, actionable steps for you. This is the Investor Action Plan, and we're drawing directly from the KMBUF report's highest conviction recommendations.
The report really emphasizes that investors should focus on the high-conviction structural trades that have proven resilient. The idea is to sort of ignore the noise of the consumer weakness as mere cyclical friction, for now. And the recommendations are very explicit. They detail entry points, targets, and the rationale behind each trade.
Let's get right into it then. The top 5 stocks with the best spread potential, starting with Advanced Micro Devices, AMD.
AMD gets a high-conviction BUI signal. The report suggests an entry point around $176 with a pretty ambitious target range of $190 to $195.
And the rationale?
It's the increasingly aggressive competition with NVIDIA. AMD is positioned not just to compete, but to gain significant market share, especially with all the anticipation around their MI450 GPU release. This specific product is crucial because it promises performance improvements that could really disrupt the current AI accelerator landscape, and that would directly lead to higher average selling prices and stronger revenue growth for AMD.
So it's a direct bet on AMD successfully challenging NVIDIA's near monopoly.
That's the play.
Next up, Broadcom, AVJO. We've already said it's a massive winner, up 140% year to date. Why would you buy it now?
It still remains a high-conviction BUI. The suggested entry is in the $365 to $370 range, targeting $385 to $395. And the underpinning here is that their AI chip demand is not speculative, it's locked in.
Locked in how?
The fundamental justification is a massive $10 billion client orders announcement. We have to pause on that number. A $10 billion order book in this specific sector confirms multi-year supplier lock-in. It means a major client, probably a hyperscaler like Google or Meta, has guaranteed business far into the future. That provides incredible visibility and certainty to Broadcom's revenue streams.
That kind of client commitment makes the stock a relative value play, even at 52-week highs.
That's the argument.
Okay, number 3, Taiwan Semiconductor, TSM, the indispensable linchpin of global chip manufacturing.
Another high-conviction BUI with a target of $100 to $105. And the rationale here is just pure dominance. TSM controls roughly 90% of the global advanced chip processing market. They are the only game in town for the newest, smallest nodes that companies like NVIDIA and Apple require.
But what about the geopolitical risk?
It's always present, of course. But the report assesses that TSM's technological superiority and its central role in the AI supply chain mean they're fundamentally insulated from immediate market weakness. Investing in TSM is really just investing in the infrastructure in the future.
All right, switching gears to resources. Kimiko, CCJ, the energy transition play.
High conviction BUY targeting $108 to $110. This is a classic supply-demand imbalance trade. Global uranium demand is surging because nuclear power is now seen as essential for decarbonization and energy stability.
Right.
But the supply remains constrained. That's due to years of underinvestment and geopolitical disruptions in major production areas. This mismatch creates a powerful structural tailwind for CCJ, as it's the largest publicly traded uranium producer.
Makes sense. And finally, the pre-earnings tactical trade. Salesforce, CRM.
This one is a medium conviction BUY, and that just reflects the inherent volatility leading into an earnings report. The suggested entry is $258, targeting $265 to $270. The rationale is simply a favorable technical setup, anticipating that those high expectations for AI commentary will be met or even exceeded. It's a momentum play, really, designed to capture the immediate run-up and a potential gap higher after the report.
Beyond these longer-term position trades, what about for the more active investor? What specific day trading opportunities based on high liquidity does the report highlight?
The report focused on stocks that showed really high momentum and volume closing out the week. Intel, INTC, is a prime example. It recently had a strong plus 10.91% move. The recommendation suggests setting an entry confirmation trigger at $39.50 and targeting $41 to $42.50.
And the liquidity is key there.
It is. With over 100 million shares of daily volume, those entry and exit points are highly liquid. It allows traders to capitalize on that sudden momentum surge without having to worry about finding a buyer or a seller.
And for those playing the crypto-adjacent volatility, the high beta stocks.
CleanSpark, CLSK, a Bitcoin miner, which recently rocketed up 13.20%, is noted for a momentum entry near $15.50. These trades are leveraging that Tinkerbell phenomenon we discussed earlier, the immediate enthusiasm in the crypto space spilling over into the highly liquid publicly traded miners. High beta just means these stocks are significantly more volatile than the general market, amplifying both gains and losses, which is exactly what a day trader is looking for.
Okay, let's turn to income investors. For those of you who might be prioritizing yield amid all this market frenzy, the report detailed some specific high-yield dividend strategies. And we need to clarify the huge difference between the ultra-high-yield plays and the reliable dividend kings.
This is a critical distinction, and we need to provide the necessary technical context for these ultra-high-yield instruments. The report lists Lument Finance Trust, LFT, at an eye-watering 17.22% yield, and Two Harbors, 2O, at 15.87%.
And these are not standard companies.
No, they're typical not standard operating companies. They are often mortgage REITs or M-REITs or business development companies, BDCs.
And why is that important for you, the listener, to understand?
Because that high yield is compensation for structural risk. M-REITs, for example, they borrow short-term money to buy long-term mortgage-backed securities, and they rely on that spread. When interest rates are volatile, their balance sheets can get squeezed, and that can lead to dividend cuts or capital erosion. They are complex instruments. And while the yield is tantalizing, you have to understand they carry substantial balance sheet and interest rate risk. That yield is not guaranteed, and the principal can be highly volatile.
So they require a lot more active risk assessment.
Far more than a traditional stock. On the other hand, you have the quality long-term dividend players, the dividend kings, and they offer reliability over the sheer size of the payout.
Right.
Here, the focus is all on stability and a long history of increasing payments. The report highlights giants like AbbVie, ABBV, a pharmaceutical powerhouse with a 50-plus year streak of dividend increases, currently yielding 2.9%.
A very different risk profile.
Completely. Johnson & Johnson, J&J, is another staple dividend king with a 2.7% plus yield. Coca-Cola, KO, also maintains its status. These companies are generating steady cash flow from non-cyclical essential products, which makes their income streams resilient even if the stock market takes a dip.
The report also mentioned a couple of others for higher income.
Yes, it highlights Pfizer, PFE, with a very substantial 6.7% yield, and Energy Transfer, ET, which is a midstream energy play with a 7.8% yield. These are for income investors looking for a higher current payout from established, if maybe slightly less diversified businesses.
We have covered so much ground: the macro shift, the volatility context, the risks, the actionable trades. Now, we have to circle back for our final segment, the deep dive into the semiconductor structural thesis, because it seems like every single positive market factor, the VIX signal, the NASDAQ outperformance, the high conviction buys, they all point back to the chips.
This is really the most crucial part of the entire analysis. The outperformance we're seeing isn't a flash in the pan. We are witnessing a structural, secular trend driven by three factors: the necessity of AI, the expansion of high-performance computing, and, frankly, geopolitical competition. This is why the KING-KAMBUF report reiterates the long-term case for the top chip companies.
Let's start with the undisputed leader, NVIDIA. NVDA, even with its staggering, $4.3 trillion market cap, the report still views any dips as a buying opportunity.
That's because, despite the incredible run and the 27.2% YTD gain, NVDA maintains overwhelming dominance in the architecture of AI chips. That minor 6.5% monthly pullback they experienced, that was healthy. It cleared out some weak hands.
And the long-term thesis is still intact.
It's all about their CUD software ecosystem, which locks in developers and enterprises. No other company has a comparable full-stack offering. It makes them indispensable. When an enterprise decides to adopt generative AI, they're almost certainly running on NVIDIA architecture. That structural dominance is not going away quickly.
And then there's Broadcom, AVGO, leveraging that infrastructure push.
AVGO's 45.7% YTD gain confirms their successful pivot. They are focused on specific, high-margin, custom AI chips and infrastructure solutions. That $10 billion client order we discussed isn't just about revenue. It's about AVGO solidifying its position as a custom design partner for the largest consumers of AI hardware. That ensures robust institutional support and predictability well into the future. They're not just a networking company anymore. They are an AI hardware essential.
Advanced Micro Devices, AMD, is playing that aggressive challenger role. The report highlights a staggering statistic. Their MI350 AI GPUs are showing a 35x improvement. That needs more context.
That 35x improvement figure is massive. It really speaks to their technological leap. What it means is that in specific benchmarks relating to high-performance computing tasks, the very tasks required for training large AI models, their new generation of chips delivers performance 35 times greater than the previous generations.
And a leap like that lets them gain share.
Aggressively. They're not just selling chips. They're gaining strategic partnerships with hyperscalers like Microsoft, Meta, and Oracle. Those companies need a viable, high-performing alternative to NVDA to diversify their supply chain and mitigate costs. AMD's success is critical for the overall health of the entire AI supply ecosystem.
And we mentioned Taiwan Semiconductor, TSM, the foundation of it all.
TSM is simply indispensable. They dominate 90% of the global advanced chip processing market. They're fundamentally the bottleneck for the industry, which means they benefit regardless of whether AMD or NVIDIA wins the design race, as long as the demand for advanced silicon is strong. Their ability to deliver the most cutting-edge nodes while navigating immense geopolitical pressure is why they are a core long-term holding for so many.
Okay, finally, let's look at Texas Instruments, TXN. It's the underperformer in terms of YTD gains, barely up 0.9%. Why is this included in the core structural holdings?
TXN is the counter-cyclical hedge within the chip space. They focus on analog and embedded processing. These are the chips that go into industrial applications, automotive systems, essential electronics, not the volatile cutting-edge AI race.
So it's a stability play.
Exactly. Their stability and exposure to the broader industrial cycle make them significantly less volatile. The report cites an analyst target of $220, which represents a potential 16.1% upside. For investors who want chip exposure but are looking for reduced risk from the intense AI valuation swings, TXN provides a high-quality alternative that's leveraged to long-term industrial digitalization rather than immediate hyperscaler expenditure.
So to summarize the market outlook for you, the listener, we have a major technical buy signal, we have overwhelming structural technological momentum, but it's all happening against a backdrop of measurable consumer caution. What are the key action items?
The synthesis of the data suggests a calculated approach. First, you have to recognize the dichotomy. Accumulate quality semiconductors like AMD, AVGO, and TSM on any dips. The structural demand thesis is the market's primary engine, and that conviction is real.
Okay, number one is stick with the winners.
Number two, use the upcoming earnings from Dollar General and Salesforce as your fundamental barometer. DG tells you if the consumer is buckling, and CRM tells you if the corporate spending engine is sputtering. They provide the context you need to either hedge or double down.
And the third.
Third, you utilize that VIX signal as your near-term strategic framework. That 22-day confidence window suggests a strong, technically supported path through the holiday period, which favors momentum trades. So the strategy is to ride the structural wave while keeping one eye firmly fixed on that cyclical consumer risk.
That context is just so powerful. We saw a tough November, completely wiped out by a rush of conviction buying, and it was entirely focused on technology and resources. The positive factors, the technical VIX signal, the AI momentum, the strong capital flows are undeniably driving the markets forward.
So what does this all mean? It means the market is currently experiencing an extreme bifurcation, and it's driven by technological necessity. The structural trends in AI and energy are so powerful they are creating these isolated pockets of staggering wealth generation and market highs. But we cannot let that euphoria blind us to the fact that these gains are fundamentally masking a deteriorating consumer condition.
Which we see in the severe pain in retail, housing, and durable goods.
Exactly. This market isn't climbing uniformly. It's being pulled up by two incredibly strong ropes, AI and energy, while its foundations in the consumer economy are looking distinctly shaky.
And that is the essential tension we need to focus on as we approach year-end. If the momentum in AI and semiconductors is structurally strong, pushing major stocks to repeated 52-week highs, but key consumer sectors like housing and retail are simultaneously signaling caution with 52-week lows and massive single-session losses, how long can this market dichotomy persist heading into the new year?
That's the billion-dollar question.
Does the AI boom eventually create enough capital wealth to lift the broader consumer economy? Or does the deep consumer slowdown eventually dampen the high flyers, forcing a rotation back toward value? That is the provocative question for you to mull over as you position your portfolio for December.
An intellectual and a financial challenge indeed.
Thank you for joining us on this deep dive into the reserve of KING-KAMBUF Financial News and Reports Magazine Weekly Market Digest Week Ending Report. We hope these insights provide you with a clearer path through the final trading weeks of 2025.